typically choose growth over profits. So they run freebies or lower prices of their products and services, eventually sometimes making losses just in order to get some adoption and users. But sacrificing profits also means that the startups may become unsustainable and need significant upfront investment to pursue such a strategy. Venture capital firms are often willing to provide this investment for scalable startups. Now, Africa's small consumer market also poses some problems to this particular strategy. Now, joining me from Abuja, Nigeria is Enokela Ineke. He's a financial analyst, and we're going to look at helping Africa's startups scale beyond the issues of growth into profitability. Victor, welcome to Business Edge. Thank you so much for joining me.
Thank you so much for having me. Thank you so much.
So let's look at how effective this strategy of freebies and promos actually is for many African startups. We see it from ride hailing to food delivery to all different types of startups which use these strategies to bring users on board. In terms of bringing the users and even keeping them, is this really an effective strategy?
Firstly, I must start by saying there's this culture right now of consumers being pampered. You know, a recent survey in the United States showed that like 70% of consumers say, look, I'm not going to try a new business. I'm not going to try a new startup if I don't have something in it for me. So these startups actually saw this. They discovered that most consumers no longer just want to try another startup because of the plethora of products available. You know, there are a lot of products, a lot of companies, startups offering similar services. So it has gotten to the point that it's just like a marketplace, and consumers actually have a choice. Like if you talk of fintech like Kuda or Pay, you know, there are choices for consumers to pick. If you talk of savings, we have Cowrywise, Piggyvest. These startups offer similar services. So at the end of the day, you have to give backs, commissions, and to just draw in customers. And if we look at most startups that are doing well, like Kuda, that reached the $550 million evaluation, they started with commissions, bonuses, referrals, just to get people on board. So at this time and age, in as much as some people might argue that it affects cost, but at this time and age in Africa, it's really a good strategy to use.
So it's a good strategy to use, but let me also ask you, is there an in-between strategy? Because most likely at the times where these companies are using this as a strategy, it is costing them more. It's definitely costing them more. It's not bringing in as much, but it's bringing in adoption, definitely. So would you say that there's some kind of in-between strategy that companies can use in the early days when they're pursuing growth, because they still need the numbers of growth to show the investors who may come in with the money?
Okay, to answer that, when we look at most startups in Africa, right, the problem we have is duplication of solution. Like I said, you know, many startups offering the same solution. To tackle this problem, we need startups coming up with unique solutions, like unique solutions peculiar to our own market, solving specific problems. You understand? So now, if we have unique solutions, you can be able to do away with all those commissions, because what will happen eventually is that customers, clients will just come in organically. You don't need all these specs and other things to bring people in. And also, most of these businesses, for example, a startup like Uber, because Uber was actually pricing the services too low, doing exorbitant marketing, but its CEO, Kojosaski, just said a few weeks ago, he said, you know what, we're going to cut down costs. And look, interest rates are going up, price of labor is going up, price of energy is going up. For us to sustain, we need to be able to increase the prices that we offer to our customers. So the same thing for startups. I believe that the pricing should be optimal. In as much as you need customers, you need them to patronize your services, you need to place a price that will make sure that you still have be able to break even, basically, because most startups, unfortunately, are running at a loss just to acquire customers and adoption.
Let me pick up on that. Given the example you just used, because of the prevailing economic situation, we're seeing one startup that has to adjust its prices, maybe doing away with some of its promos and its freebies. So what happens when that strategy is removed? Where does the customer go? Do we see customers staying, or because there are so many other startups that do and offer similar services, they just migrate to one that continues to offer them some kind of freebie or some kind of promotion that at least brings the cost down a little bit? So when you remove this strategy in the markets, what happens next?
Unfortunately, for most startups, when you remove your freebies and your perks, customers leave, right? Because I know many people who joined some of these startups, downloaded their apps, basically just to receive referral bonuses and commissions. And the moment the company announces, you know what, guys, we no longer do commissions. When you bring in new referrals, there's nothing for you. They jump up to the next opportunity. But at that point, it's left to the company, left to the startup to innovate. Being a startup, being in the game for a while, you have that competitive edge over a newer entrant into the market. So that's your edge now should be what you bank on. That's what is your advantage. So for startups who remove commissions just to be able to keep the revenue line, just to be able to make profit, I believe a counter strategy is to make sure that they up their quality, up customer care and support, up the quality of service. I use fintech as an example because many people, after they remove the perks, you see there's still problems of transactions not going through, debits and the rest. But if you remove your perks and you fix and sort out all your issues, at the end of the day, you still have loyal customers. But I don't want to be the bearer of bad news, but some customers will definitely leave because some of them actually are there just for the perks. So it's unfortunate, but that's just the truth. Some will leave, but if you increase your services, I can bet that a good proportion of them will stay and be with you.
Definitely true. So a word that has become a bit more commonplace I'm hearing is subsidy. Now, we often don't think about subsidy when it comes to tech startups. We hear about it in fuel, in food, in agriculture, but now subsidy in tech startups. So Victor, I need you to explain this to me because some research is suggesting that public subsidies could be essential to the survival of startups. What's that all about?
Yes, subsidies for startups are necessary. The government needs to look into subsidies for startups because at the end of the day, these startups are the ones that create the jobs. Because in 2025, it's estimated that we'll have at least 1.3 million jobs from startups and digital economy in Nigeria. So it is just wise for the government to try to incentivize startups. The harsh economic conditions, they need to start up. And now the subsidy for startups is in two phases, actually. There's a subsidy for investors. The government offers them loans and finances the capital investment in the startups so that they do not need to source not the financing, but the whole framework behind it. They do not need to source for that. Then there's also the guarantee and strategy, whereby the government be like, okay, you know what? But I'm calling on investors, come and invest here. If you encounter some sort of loss, will be a certain percentage. Now, that's from the investor side of things. But now, for the startups themselves, there are many things the government could do to incentivize startups. You could do some things like taxes, to reduce taxes for startups so that they be able to cut those costs. You can't cut all costs, but if you could reduce taxes for them, it's be a plus. And also, I think in May, the FEC had a meeting and directives, that is the Nigerian government, directives were given to MDAs and they say, look, reduce taxes for startups, right? And also when they're trying to access loans, just reduce interest rates. These things look small, but when everything or the policies add up together, you see that many startups are able to dive into the market. And also, some startups have problems of foreign exchange. Some of them want to procure equipment, procure whatever from outside, and they need foreign exchange. So the government and the central bank could also help them to secure this forex easily, because we see a situation whereby the CBN and the BDAs, they're like, okay, now we're not going to supply forex to the BDAs and the rest. That's for Nigeria. So other countries and central banks generally should make it easier for startups to access foreign exchange, so that when they try to get stuff outside, it just becomes easy for them. And these things look small, but when you encounter such problems as startups, you understand that just a little bit of push is all you need to just scale and move on.
All right, and we'll end the conversation on that note. Thank you so much, Victor. I know that with the conversation around startups, there's a lot more to talk about, especially with the amount of funding that Africa has been getting, with the focus being on Nigeria, Kenya, South Africa, and of course, Egypt. So Victor, we'll see you again sometime soon. And you are watching Business Edge. We're going to wrap up in just a bit, but before we do that, Lekan has NC4 to watch.
On NC4 to watch, let's tell you that Kenyan homeowners and businesses producing more than 1 megawatt of electricity from solar will be required to sign power purchase agreements with Kenya Power as the country gears up for increased generation of renewable electricity. Away from that, the 93 million rand corruption and fraud case against former Transnet CEO Siyabonga Gama and 4 others has been postponed to next month. Now, South Africa's power utility may need to borrow an extra 45 billion rand, that's about $2.6 billion, to purchase diesel and pay inflation-beaten salaries to workers, according to S&P Global Ratings. And finally, the Nigerian government is set to currently be engaging oil marketers over the cost of premium motor spirit, also known as petrol, as well as fuel queues, bridging claims payment, and more, even as there are speculations that the meeting could lead to an upward adjustment in pump price. And that's all on NC4 to watch. Tolu will wrap up the show now.
Thank you so much, Leika, and thank you to our guests for joining us today. If you've missed the episode at all, don't forget you can head to our YouTube channel, subscribe, and make sure you don't miss anything. Download our mobile app and find all of the episodes of Business Edge there. Follow us on social media. We are at News Central TV, and of course, watch us on the platforms we are available. Until next time, 11 a.m. West African time, where we're putting African business front and center right here on News Central, where we put Africa first. I'm Tolu Lokwe Adelaru Balogun. Have a fantastic day.